Welcome to this explainer. Right now, the absolute smartest investors in America are doing something that might look a little crazy. They're acting completely opposite to the public panic around real estate. So let's dive into the 2026 real estate reset and look at exactly how the wealthy are turning all this massive uncertainty into generational wealth.
Real estate is dead, mortgage rates are too high, home prices are impossible. Just 2 years ago, millions of people were saying exactly this, right? The headlines were literally flooded with fear. Picture this. Practically overnight, buyers just vanished from the market. Sellers, who were totally used to easy money, started to panic. Social media was screaming about an imminent housing crash and collapsing demand. Basically, everyone was convinced the market was completely untouchable.
And the spark for all that panic really comes down to one single number, 7%. Let's tell a quick story to make sense of this. Imagine a buyer who spent months carefully budgeting for a house. At a 3% mortgage rate, they could comfortably afford the monthly payments on their dream home. But then, the Federal Reserve stepped in to fight inflation, and mortgage rates surged. Suddenly, that exact same buyer, looking at that exact same house, faced a totally different reality. At 7%, hundreds of dollars were added to their monthly payment. The math just flat out broke.
And man, the shockwave was rapid and brutal. First, the Fed raises rates over a period of months. Second, mortgage costs jump dramatically in just a matter of weeks. And third, buyer demand drops off a total cliff in days. It was a sequence that pushed retail buyers right out the door. Transaction volume plummeted, builders pulled back, and to the average American, the housing market looked totally and completely broken.
Section 1. The Hidden Shift. How Leverage Swapped Sides.
Now, behind the scenes, with almost zero media attention, experienced investors didn't see a broken market at all. They saw a strategic reset. Look at the difference in mindset here. The average person cowers under the storm clouds of market uncertainty and just waits for safety. But the wealthy investor? Well, they know a fundamental financial truth. Certainty is expensive. By the time the headlines are positive and everyone finally feels safe, prices have already recovered. The best deals are long gone. Wealth is usually built when fear creates pricing inefficiencies.
When higher rates pushed those retail buyers out, the competition just vanished. Picture a property that used to get 15 aggressive offers on its very first weekend. Suddenly, it's sitting empty for weeks. And because of that, sellers who used to demand top dollar became incredibly flexible. Developers sitting on expensive construction debt got highly motivated. The power completely swapped sides. The buyer with capital and patience suddenly held all the cards.
Section 2. The Delayed Demand Boom.
Here's the thing. Housing demand didn't just evaporate. It just got delayed. People didn't suddenly stop needing places to live. Job markets are still shifting, young professionals are still forming households, and millions of millennials are still in their prime home buying years. And because buying became less affordable, renting naturally surged. Investors who focus on cash flow started aggressively targeting highly resilient rental markets in places like Texas, Florida, Tennessee, Arizona, and the Carolinas. When the average person is locked out of buying a home, they rent. That keeps occupancy rates incredibly strong and creates phenomenal cash flow opportunities in these high-growth Sunbelt states.
Section 3. Math over Emotion.
So how do they actually pick the right properties? Well, smart money completely ignores aesthetics. Here's their actual playbook. Instead of obsessing over beautiful kitchen backsplashes, they look at cap rates and cash-on-cash returns to focus purely on predictable income yield. Then they use the debt service coverage ratio, or DSCR for short, to measure risk, basically ensuring the property's income easily covers its loan payments. That creates deep financial safety. By sticking strictly to these metrics, investors gain a level of control that a volatile, emotionally driven stock portfolio simply cannot offer.
And the math gets even better. Real estate comes with a seriously powerful financial shield, hidden tax advantages. High-income earners and business owners absolutely love real estate because of powerful IRS rules like depreciation, mortgage interest deductions, and advanced strategies like cost segregation. These aren't just little perks. They are massive wealth-building tools that improve your cash flow and sit perfectly alongside traditional 401ks, Roth IRAs, and ETF portfolios.
But honestly, the ultimate wealth hack is inflation protection. Think about it. When inflation goes up, the cost of living goes up. But real estate acts as a hedge. Your debt stays perfectly fixed, but replacement costs rise, and most importantly, the rent you collect rises. Real estate naturally adjusts with inflation, preserving your purchasing power over time, and that is exactly why institutional investors and family offices pour capital into housing, even when average buyers hesitate.
But hey, a quick word of caution here.
Not every cheap house is a good deal. Smart money puts crucial market fundamentals under a massive magnifying glass. They study job growth, infrastructure, school districts, crime rates, economic diversification, and vacancy trends. A cheap property in a declining neighborhood isn't a deal. It's just a liability in disguise. Experienced investors spend far more time intensely studying these exact geographic and economic fundamentals than they ever do browsing property listings.
Section 4. The prep work.
Financially disciplined investors take highly actionable steps, often years in advance. We're talking about boosting FICO scores, lowering credit utilization, and optimizing debt-to-income ratios. Why obsess over this? Because in real estate, financing is literally everything. Shaving just a few percentage points off your loan terms because you have an elite credit profile can save you tens of thousands of dollars over the life of a property.
And here's the absolute best part. You don't even have to buy a traditional single-family home to play this game. Investors are evolving into alternative strategies like duplexes, triplexes, short-term rentals, build-to-rent communities, and even real estate syndications and REITs. You can participate, build equity, and create huge financial leverage without necessarily ever unclogging a single toilet or becoming a full-time landlord. The vehicles might change, but the core wealth-building principle remains exactly the same.
Section 5, the 2026 Wealth Window.
Wealth is rarely built by waiting around for perfect conditions. So ask yourself, is this temporary uncertainty actually your perfect setup for the next generation of wealth creation? While millions wait for safe headlines, the smart money is already moving. Stop waiting for perfect certainty, start running the numbers, and position yourself for the next cycle.